Good afternoon, ladies. This is the last chapter on theme one, markets, consumers and firms, and this is chapter 22, business survival, cash flow, narrated PowerPoint. So this is essentially the last topic within theme one, and then obviously next meeting that we have online, we'll be talking about the content that we've gone through, and then deciding on how we're going to move things forward in terms of assessment, and also moving on to topic two, or theme two, which is the wider economic environment. But for the moment, we're looking at business survival and cash flow. Fairly important principles, as you can imagine, for any business, because at the end of the day, if businesses don't survive, then clearly in that situation, the economy isn't going to thrive, and we're not going to have the jobs that we want, and we're not going to have the income that we want, and so economic growth and aggregate demand is also going to suffer. So a couple of questions, a couple of quotes for you to take a look at, okay? Sanity for vanity, profit for sanity, but cash is king. And then Peter Jones, who is responsible for some very successful businesses, and is one of the the lead entrepreneurs on Dragon's Den, said profitable business can still go under if they run out of cash at a critical moment. Forecasting is the most focused method to avoiding that obstacle. So it's one of the points I was going to make later in the presentation, that basically you can be a profitable business, but if you have not got enough money to keep your business going from day to day and then pay for all your day-to-day expenses, i.e. you haven't got enough cash, then basically a very profitable and potentially successful business can still go out of business, as we'll see. Okay, so trying to make sure that you've got enough more cash coming in than you've got going out, is clearly a critical skill that all businesses are going to require. So this PowerPoint, we're looking at revenue, costs, profits and cash. Okay, let's move on then. Okay, and let's take a look at these issues around business survival and cash flow. So first things first, I'm just going to move myself up there, based on some feedback that I received from one of our students, which is particularly pertinent. So 1.6.4, business survival and cash flow. So what we're going to do first and foremost is look at some of the definitions, some of the things we're going to cover in these slides, next few slides. We're going to look at the distinction between profit and cash flow. Profit and cash flow are not the same. Lots of people get mixed up about, well, surely profit and cash flow are one of the same thing. They are not. And we'll look at the reasons why they're not and what the distinction is between the two things. We're also going to look at the importance of cash flow, absolutely critical to get your cash flow right and to be able to forecast where your cash flow is going to go from one week or month or quarter to the next, okay? Clearly very important for business survival. In terms of how we might actually look at that, we're going to look at forecasting cash flow and also how we can interpret cash flow forecasts in order to see whether there are any issues, whether we need to do something about raising finance for a particular period of time to cover a cash flow shortage. We're also going to look at how you might use a cash flow forecast to identify credit requirements and minimise risk, and clearly there's some very important principles within that. If we can identify and head off a problem at the pass, or maybe look at refinancing something in order to make that more successful, that's clearly another thing that we can do through the use of cash flow and cash flow forecasts. Okay, so first things first, then, the distinction between cash flow and profit. And this is a really important one for you to understand. Okay, so profit basically is when we've taken into account, looked at all our financial records, looked at our comprehensive income statements. What profit shows is when total revenue has been greater than total cost. And clearly, it's almost an historical thing, isn't it? It's looking at how much revenue we've raised, what were our total costs, and if there's anything left over, once we've taken away total costs, we have achieved profit. However, cash is actually the physical existence of money within the business, okay? So if we've sold some goods and services, let's say we sold some glasses to somebody, we're selling specs for our business, then effectively, let's say we've sold a couple of nice design of Ted Baker frames with bifocal lenses. Maybe we've paid a couple 250 quid for them as a customer. Well, essentially what the business does is swaps the goods for cash or for money. Now, clearly, cash is not quite such an important way of making transactions these days. But fundamentally, even if we're paying for that on a debit card or a credit card, then there is the function of money. The money is transferred, cash is transferred from one account to another in order to facilitate that whole transaction. Okay. Now, clearly, when we talk about cash flow, particularly, and it's sort of there's a bit of a clue in the title. It's about the inflows and outflows of cash into a business. So, cash flowing into a business is the example I just gave, where we've sold some specs and we've got £250 for those spectacles. Okay, but the money going out of the business, flowing out of the business, are any costs that we might have to pay, any liabilities that we might have to pay. And clearly, getting the timings of cash inflow and outflow right is going to be critical to business success. As we said before, profitable businesses, essentially those that are actually getting more total revenue than they are total cost, can still fail if they have a lack of cash at a certain time. And the timing of those cash flow issues is clearly very important. Why is profit and cash different? Well, actually, there's a number of reasons for that. Now, as you'll know, and we have mentioned previously, in some cases, some businesses have to offer credit sales. Okay. Now, essentially, that means that somebody buys some goods or a good or a product of some description and isn't going to pay for it straight away. So they might get that good on 30 days credit. So it means that they get use of the goods straight away, but they don't start paying for it until 30 days later. Okay, now that's obviously what's known as credit terms, or in this case, credit sales. Okay, now the other thing that we can sometimes get in certain scenarios is we can get bad debt. So if we actually have a situation where we've offered somebody a credit sale, okay, and then they can't for some reason pay that money back, if we've actually tried to recover that debt and aren't able to for whatever reason, then we get what are known as bad debts. They're debts that go bad, essentially, as the term sort of implies, and that's when you basically don't get paid the money that you're owed. And clearly that can be a fairly critical problem for any business, because bad debts mean you don't get you've provided the goods, but you haven't been paid for them. We've only been paid a small amount rather than the amount that you're expecting to get paid when you actually first negotiated and agreed the transaction. We could have heavy stock holdings. Okay, now that might mean that we've got lots and lots of money tied up in stock. We haven't necessarily been able to sell that, or we might need to add some value to that, change the stock in order to be able to sell it in some shape or form. We could have high investments in fixed assets. Okay, so we might have chosen to invest quite heavily in fixed assets, and that clearly means we've got cash tied up in those fixed assets. And clearly there's also this issue of seasonality. Okay, now clearly we know that if we're in the tourism industry, we're going to make a lot of money and lots of cash sales when the tourist season is at its height, but during the rest of the year, then clearly we're going to have probably some fixed costs that will still go out of the business, but we're not going to have that normal cash flow pumping through the business. And again, it's a case of trying to manage that process in the best way that you can. And then clearly we might also have to repay some loans. If we've got liabilities of some description, we are going to have to think about when we're going to pay those, how we're going to pay those, and still keep the business running in the most efficient way. So let's take a look at the principle of and the nature of cash flow then. So we've basically got cash flowing into the business, and examples of that include clearly cash sales, so where we've actually sold our specs and received some payment. We might also get payments from debtors. So debtors are those people that have actually originally taken goods from us on credit and they haven't yet paid us. So at some stage, let's say in 30 days, they will pay, and then there will be further payments coming into the business, cash flows coming into the business. If the owner has any capital invested, that is money that's gone into the business. So that's, again, an inflow into the business. We could choose, if we wanted to sell some assets. And if that were the case and we received some money for those assets, then clearly that would again be a source of cash flow into the business. The other alternative is that we might choose to finance our business by borrowing a certain amount of money, and we might choose to take out a bank loan in order to expand or to cover a cash flow issue, or to look at launching a new product, whatever it might be for. That again, it would be a legitimate source of money coming into the business. That's cash flowing into the business. Okay. Now, when we think about cash flows out of the business, okay, outflows, these include things like purchasing stock. Clearly, if we need to produce more goods and services, then clearly we're going to need to, in lots of cases, we're going to need to buy raw materials. We might need to pay wages. We might need to pay debts. So any bank loans, any interest that we've got on loans, any creditors where we've taken credit. So we, as the business, have bought goods and services that we can then transfer and add value to, and create a new product that we can sell. Our creditors, people that were our suppliers that have given us credit, we will clearly need to pay those back at some stage in the future too, and that would be another source of cash outflow. If we decide to purchase assets for the business, again, that's money that's coming out of the business. Okay, so the basic principle of cash flow and the real interest, and if you as a business person were thinking about how you would use a cash flow forecast, is trying to balance the inflows and the cash outflows in terms of their relative size and their timing. So ideally, if we've got more money coming into the business, more cash flows into the business, and we've got outflows, then we're in a good spot. But clearly, the timing of those and whether we can synchronize those timings effectively is going to be a real issue in terms of, and quite an art really, in terms of trying to manage that process, in terms of trying to keep the cash flow positive. So let's have a look at the nature of cash flow then, okay? And before we do that, let's just have a think about the most common reasons why businesses fail, why small businesses fail, okay? And there is a link that I'd like to go and take a look at, which lists 11 different reasons why. But I also want you to think about whether you think how important you think cash flow is within that 11 common reasons. Okay, more often than not, successful businesses or potentially successful businesses fall down big time due to not anticipating the cash flow issues that they might face. So why is it so important? Okay, well, clearly a business needs to make sure it's got enough positive cash in the business in order to meet its day-to-day expenses, because if it's not able to do that, at some stage it might well be that those day-to-day expenses all become due, and if we can't pay all of our day-to-day expenses, then we could get ourselves into a very sticky financial position as far as a business is concerned. Okay, so what we try and do with these tools is to, number one, put a cash flow forecast together, and that's very much a forward-looking statement. So we're trying to predict cash inflows and outflows. Again, the clue's in the title. We're trying to forecast, and as we said before, forecasting is every business's nightmare. It's very, very difficult to get an accurate forecast. So to some degree, you're going to use your own sort of gut feeling and also any experience that you might have to try to predict when you're going to get cash inflows, when you're going to get money into the business, and when you are going to have to pay money out in the future. And clearly, having a decent handle on that and a decent system of some description that is going to allow you to forecast both those inflows and outflows is clearly going to be a very important part to ensuring cash flow is not going to become a burden to the business. So very important, we've talked about things that when we're drawing up an idea for a business and how we might take it forward and hopefully get some investment to put a business plan together, okay? Now that will sometimes include break-even analysis like we talked about previously, but also cash flow forecasts so that a business or an investor or somebody who's interested in helping you in some shape or form, maybe the bank, can see that you've actually considered when you're going to get money coming into the business and when it's going to be going out. So effectively, it's showing that you're forecasting and trying to manage that process effectively. that's a cash flow forecast. But what you can also do is use cash flow statements, okay, which essentially is almost a backward-looking statement, which actually shows what happened in reality. So you can compare what your forecast was with what your statement is, and clearly see whether there were any shortfalls within that, and any anything that you can learn from that process. Again, normally use cash flow statements, normally presented as part of the business accounts. So we talked again about income statements and statements of financial position we haven't looked at, but they're also known as the balance sheets. But cash flow statements can also be presented as part of business accounts to show how well you are controlling your cash within a business. Like we said before, in some cases, potentially profitable businesses may fail if they haven't got a handle on their cash flow, if they haven't made sure they've got enough inflows to cover all the outflows. And more often than not, that is a timing issue rather than anything else. But clearly, if you get your timing wrong, that can put you in a very vulnerable position as far as your business success is concerned. Okay, so let's have a look at how we might construct a cash flow forecast then. So there's a little bit of theory here. Well, I say theory, a few words and a few notes for you to consider, and then we'll look more specifically at what a cash flow forecast looks like. And it's a pretty straightforward process, to be honest, but there are a couple of very important principles that you need to remember when we start to look at cash flow forecasts. Okay, so first and foremost, we've got to try and forecast cash inflows, money coming into the business. Okay, well, clearly we've said that an owner who might invest or another source of finance is a legitimate cash inflow into the business. Any cash sales that we might get from our estimated sales forecast. So we might actually look at what we think we're going to do, how many sales we're going to achieve based on all the marketing and advertising we're going to do. And clearly, in that case, we would be able to hopefully forecast how much how many cash sales we're going to get coming into the business. And that, again, is a legitimate cash inflow. Okay. Now, more often than not, again, it's a really difficult, having done it before on numerous occasions, both for my own business and also when I was working for other businesses. It's very, very difficult to get an accurate sales forecast that you can absolutely 100% rely on. So sometimes it can be over and sometimes it can be underestimated. Okay. Clearly going to depend on how much research that you can do and how many customers that you can nail to the floor and say, right, you said you were going to give us these sales. Is this going to happen? Okay. And clearly that, dependent on external factors and things that might change in a market, might also be quite difficult for them to forecast, let alone you. So clearly that can be a bit of a tricky one to deal with. Very difficult for a new business unless you've got guaranteed accounts and guaranteed contracts. It's almost impossible for you to estimate those with any sort of degree of confidence. And so to some degree, clearly, you can look at one day's trading and another day's trading and try and get some sort of trading pattern. But obviously, as a new business, really quite difficult to get that accurate. Clearly, when we think about this and think about new businesses, an entrepreneur clearly has to be able to do a whole range of things. One of the things is clearly to make sure that they understand how cash flow is forecast, okay, how some of the estimates might have been calculated. Are we talking about a new product or service? How are our competitors going to react? And all of those things clearly are going to be significantly difficult to estimate. And I suppose to some degree it's a case of sometimes taking a bit of a punt, but trying to avoid that where possible by making sure that the estimates have been as thorough as they can be, and that we've maybe investigated what competitors might be doing, what sort of pricing strategies they're putting in place, and then trying to reflect that in terms of how and where our product or service sits within the overall market structure. Other things that we can actually include within cash inflows are debtor payments estimated from the sales forecast. Remember, those are people that have bought goods from us, but they've taken those on a certain period of credit. So they've taken the goods, but they're paying for them at a later stage. Okay, so debtors are legitimate cash inflows, and we can account for those within our cash flow forecasts. That's clearly going to be determined by the credit terms that you offer to customers. In some cases, you might offer 30 days. In some cases, you might offer 60 days. And in certain instances, if you get a very strong and powerful customer who is actually going to be, paying, or maybe responsible for over 50% of your turnover, they might actually request 90 days. So they get the goods that you're providing to them, but actually they don't pay for them for 3 months. And that obviously can put a bit of a strain on your cash flow forecast. Clearly, in that situation, are your debts going to be paid on time? If they're not, then clearly that is going to affect your cash flow forecast quite significantly. And making sure that you've got a really tight debt management system with somebody who is very good at chasing up debts and making sure that those debts get paid on time is absolutely critical to all businesses, but most importantly for small startup businesses, where making sure that somebody who is actually responsible for chasing those debts is going to be doing that job very efficiently for you. And that's exactly the point I'm making there, really, is that how good is your firm's credit control? Can you make sure that you're going to get paid on time as far as you possibly can? Because that can be absolutely mission critical to being a successful business. Okay, let's take a look at other things that we might have to consider then. So those were our inflows. Let's have a look at forecasting cash outflows then. So we might have to pay fixed costs like rent and rates and other fixed costs that don't vary with output. Clearly, those are going to be regular outflows, and we pretty much know when they're going out of the business. Okay, should be relatively easy to estimate on a month-by-month basis, because if they're fixed costs, they don't change, do they? They don't change with output, so that should be relatively straightforward. Okay, sometimes there can be issues in terms of delays between estimates and signing of contracts, and they might actually cause some inaccuracies when we come to trying to estimate fixed costs. Okay, now clearly payment of variable costs, so we're talking about costs that vary with output. They might be things like stock and raw materials, but again, in some cases, if sales are quite difficult to forecast, then so are the costs associated with meeting that demand. Okay, so we might think that we only need 700 items to cover all of the sales that we got in the last couple of months, but actually, if we have a real bumper month and we want 1,000 items, or we get 1,000 items that we've sold, then clearly we're going to have to get more of our raw materials to meet demand, and that clearly is then going to cause a bit of an issue in terms of our cash outflows. Okay, in some cases, obviously suppliers are free to change the prices charged, and clearly instead of being able to say, well, we know how much those variable costs are going to be per unit, that clearly can cause a bit of an issue in terms of exactly how accurate our cash outflows are. Unforeseen expenses, things like one-off payments when we weren't expecting that. So maybe a machine breaks down and we have to get some maintenance that wasn't planned included within that, where we haven't planned for things. Clearly, if that's going to be an unforeseen expense, and we get all sorts of them, don't we? And everybody doesn't only need to be a business to get unforeseen expenses. But when they're one-offs, then clearly those have to be allowed for within the cash flow forecast, or perhaps some sort of contingency allowed for. Payment terms clearly is going to have an effect. Okay, if your supplier changes terms and wants payment sooner, or a lender demands their money back, then clearly that's going to mean that the outflows during that particular month or week, or however you choose to organise your cash flow forecast, is clearly going to have a negative effect on cash outflows. How do we then look at, and what sort of things can we do when we bring those two things together then? So our cash inflows show any cash in from sales, and that cash sales tends to appear in the month of sale, or doesn't tend to. So essentially, when we're talking about cash in from sales, it's when the actual cash goes in. Which month does that does the sale take place? Credit sales or receivables are going to appear in the month of the cash receipt. So in some cases, if we've got credit sales, if we've given our customers 30 days credit, then we're not going to see that money coming into our cash flow forecast until the following month. So let's say we sold it in January, but actually we sold it on 30 days credit, we're not going to see that cash receipt into the business until February. Cash from other sources, loans and investments, can clearly be used and can clearly be part of cash flow forecast. And then our cash outflows show any cash out for purchases and payments. And the cash payments are clearly going to appear in the month of purchase. And our credit payments, where we have payables, will appear in the month of the cash outflow. So if we have, let's say, 60 days credit, let's say we bought the goods in January, we're not going to have to pay for those until March. And then that's where we would get the cash outflow in March, not when we actually receive the goods. So an example could be phone usage, line rentals paid each month with call charges every 3 months. So effectively, that would be 2 different cash outflows. Your line rental would be paid each month, but you'd have your call charges charged every 3 months if that was the way in which you actually set up that particular contract. Okay, so the thing that we're then going to try to look at then is the difference between our inflows and outflows. Okay, so money coming in, money going out. We're going to end up with a net cash flow. Okay, and that's essentially where we're taking cash outflows away from cash inflows, and let's see what the result is at the end of each month. Okay, so our net cash flow is basically cash inflows minus cash outflows. Okay, now the other term that we'll need to be familiar with is the principle of an opening balance. Okay, so when we're actually talking about cash flow forecasts and trying to estimate cash flow forecasts, there will always be an opening balance figure that actually carries forward from the previous month's trading. Okay, now effectively, if we just go through this step by step. Okay, so essentially, the opening balance is basically the amount of money that a business has at the start of each month. For a new business in month 1, that would clearly be absolutely nothing because we haven't got any trading record, we haven't got any sales, we haven't got any cash within the business apart from the money that we're actually injecting in terms of the owner's capital, etc. Okay. Now, effectively, this is one of the really important principles to remember when we look at the cash flow forecast that is coming up, an example of the cash flow forecast that's coming up, you'll see that the opening balance for 1 month, okay, is always the closing balance from the previous month, okay. And so, for instance, let's say in January we have a closing balance of £1,000 in there. Once we've calculated all our inflows and outflows, we've got a closing balance of £1,000. That becomes our opening balance for the following month. Okay, so for February, and that's a really important thing to remember when it comes to cash flow forecast. Our closing balance is basically how much the business has at the end of each month. Once we've considered all of the inflows and outflows, in addition to whatever we had as an opening balance, that is going to give us a closing balance for the month, and then that closing balance becomes the opening balance for the next month. And basically, like we said, the closing balance is going to be the opening balance from during that month, okay, and then adding the net cash flow, i.e. the cash inflows minus the cash outflows. Let's take a look then, and it probably makes a little bit more sense when we see this in glorious Technicolor and with the cash flow forecast drawn up. So you can see in this instance, the first thing we do, and you can do this a number of different ways, but this seems to be a reasonably good way of going about it. We're going to list, sorry, let's go back one. We're going to list our cash inflows first. So in January, we had an owner's capital inflow of 5,000. We had cash sales of 1,600, no credit sales. So basically our total inflows for the month in January was 5,000 plus 1,600, 6,600. But you can see in the month of January, we had outflows of a van lease of 700, materials at 2,800, wages at 1,000, and other expenses at 450. So adding those cash outflows together gives us that figure there of 4,950. Now, to calculate our net cash flow, we're going to take our outflows, in this case, away from our inflows, and in this instance, we have a net cash flow during the month of January is 1,650. Now, as this was our first month of trading, we didn't have an opening balance to add to that, so our closing balance for January is 1,650. Now, we said that closing balance always becomes the opening balance for the following month. Okay, so you can see that the opening balance here is listed as 1,650, and we've got that figure from the original closing balance at 1,650. If we then take a look at what's happened in February, owner's capital, no, well, we haven't had any further injection of owner's capital, but we've had an increase in sales of 2,000. We've had credit sales of 400, so we've got total inflows of 2,400. Okay. Now, in this situation, we can see when we look a little bit more closely at this that our cash outflows for that month are 700, 800, 1,000, and 450. So a total outflow of 2,950. And in this situation, you can see that effectively we have got more money going out than we've got coming in, to the tune of 550. So we spent £550 more than we had coming in terms of inflows. Now, in this instance, because we've got an opening balance of 1,650, you can see that in this case, we take that, add that to the 550, negative 550, and that leaves us with a closing balance of £1,100. Okay, now that £1,100 as a closing balance becomes our opening balance for the next month, and you can see the pattern starting to emerge. Okay, so in this instance, you can see in March we've got £2,500 credit cash sales. We've got 500 credit sales. We've got a total inflow of £3,000. Okay, but in this instance, again, we've got van lease, we've got materials hire this time, wages the same, and other expenses the same. 3,150 as the total outflows. So effectively, we've spent £150 more than we've actually earned in terms of cash. So again, our opening balance added back to that means that our closing balance is again falling and is going down to 950. Okay. Again, in this instance, our opening balance, our closing balance in March becomes our opening balance in April. And again, I'm not going to go through each of those figures for April, but you can see that there are going to be certain pinch points going on here. And if this trend continued, so where essentially we had a closing balance of 1,650, then it fell to 1,100, then it went to 950, we can see that maybe in April, maybe things are starting to improve. What's caused that change? And one of the things that we're able to do is to look at things that have changed and see whether there's something we can do specifically about this. So for instance, we might have thought that if this was going to carry on and we kept having net cash flow as a negative, we might look at some of the expenses that we've got. Maybe we could change those expenses, reduce them a wee bit. Maybe we need to think about increasing the level of cash sales coming into the business. Maybe we need to do some more marketing, etc., etc. So this cash flow forecast we can use as a means to try and spot a problem. And then in some cases, we might think about trying to bring in some more finance to cover a shortfall. Or if we know we can see there's a big expense about to go out of the business, then maybe we could again negotiate some sort of loan with the bank to just see us through that relatively short-term cash flow issue. Okay. So how can we use cash flow forecasts and financial decision making and planning then? Well, we sort of touched on that based on what we've just talked about, but I'm just going to go through a couple of examples. Clearly, one of the big things you can do is identify any timing issues and also any significant potential shortfalls. And you might then think about maybe asking the bank for a short-term loan or maybe an overdraft of some description, or looking to refinance some of your purchases in some shape or form. So it gives you an opportunity to take a look at what might happen and then try and plan for any potential shortfall. Okay, now clearly the other thing that we can then do, once we've highlighted what the shortfalls are and what might have caused them, what are we going to do to put it right? So we need to identify what the corrective action might be, and that might be securing finance from potential investors or the bank. And clearly, if we've got a decent handle on cash flow forecasts, then that's going to tend to impress people who are going to think about investing in you, because clearly you've considered the issues and tried to address some of the issues that you might be facing in terms of your overall success. Clearly, it also can give you a significant amount of confidence about your short-term survival. If you can see that your cash flow forecasts are positive and you can see that there's a trend of improvement in those cash flow figures, then clearly you can start to plan and feel reasonably confident that you're going to survive. It also, one of the great things you can do, particularly if you're looking at both forecasting and then cash flow statements, is to take a look at what the difference was between what we thought was going to happen, our forecast, and what actually did happen. And so when you start to look at budgeting, where essentially you're looking at budget and actual, and then the difference between those two things, in this instance, taking a look at what actually happened rather than what we were forecast to do, is going to give you a really good guide in the future should you have to put future cash flows together. Some of the things that are going to affect cash flow then. So we talked about how you can use it as a planning and financial management tool. Well, clearly things that are going to affect cash flows are transaction types. So clearly if we're talking about sales, are we getting cash straight into the business, or are we actually having to finance credit? Clearly, cash coming straight into the business is a cash inflow. Credit sales aren't actually inflows until you actually receive the money. Purchases, okay, again, same principle. Are you paying cash or are you managing to get credit for those purchases? If you can get credit, then clearly that gives you an opportunity to use the cash that you saved to finance your business in other ways. And clearly, if we're paying for our purchases or having to pay for our purchases up front with cash, that's clearly going to put a significant strain on your cash flow. The payment terms we can agree, clearly also very important. Okay, can we get some extra days credit from our suppliers? Are we going to have to give more generous payment terms to some of our good customers in order to keep them as customers? Okay, so those are all things. Transaction types can clearly have an effect on cash flow. The timing of cash flow is clearly very important. Okay, seasonal sales will clearly have an effect. And obviously, when you're in high season, they have a very positive effect on cash flow. But during the low seasons, then clearly that's the time when you're going to have to batten down the hatches, not spend any money if you can avoid it, and also plan for any sort of shortfalls that might be caused by a lack of sales in certain seasons of the year. Okay, so clearly a strawberry farm is going to be making hay whilst the sun shines in the summer, but probably not selling too much in the dark days of winter. Timing of payments both in and out, clearly that's something that we as a business should manage as effectively as we can. So if we can time the payments so that when we know they're coming in, we can actually then also time the payments going out of the business, and hopefully then manage our cash flow in a very sort of active way, effectively. Okay, think about a package holiday company. Clearly, in some cases they might want money up front, but in other instances there might be a whole range of money going out of the business when the package holiday is actually taking place. The nature of the business, clearly that's clearly going to have a massive effect on cash flow. Startup capital and costs. Most new businesses find it very difficult to get credit because they haven't got any sort of trading history, and as a result of that, they will have to pay money up front for virtually all of the services that they might choose to buy, and also that means suppliers not necessarily providing them credit until they've got some sort of track record of financial success in their business. Clearly, if a business takes quite a long time to go from input to output, what I mean by that is essentially if we're talking about lots of raw materials that have to go through a number of different processes before we can get the finished item to be able to sell, that clearly is going to have a major effect on cash flow forecasting, but also money coming into the business. We're going to have to spend a lot of money on getting all the inputs sorted, and to the point where we can actually create an output, and we're not going to be able to actually get any cash flow in until those outputs are sold. Stock holdings, again, dependent on the nature of the business. It may well be that you have to hold significant amounts of stock at certain times in the year, and clearly money tied up in stock is not cash flow into the business. Okay, it's money being tied up and not actually, and in some cases, flowing out of the business because we've got to pay for that stock holding, and clearly that can be quite punitive at times. Let's take a look at timing of cash flows, cash inflows and outflows then. If we've got cash inflows and they are slow, that's going to cause us cash flow problems, and it doesn't take a rocket scientist to realise that, does it? But clearly, if we've got slow inflows, that's going to cause us issues, okay? And now a firm might try to speed up its cash inflows and can do that in a number of different ways. It might offer discount for early payment or alternatively penalties for late payment. Maybe trying to provide incentives of some description in order to get money in earlier, okay? Now, clearly, one of the really important things as far as this is concerned is making sure that you chase your customers for payment, okay? Having good credit control in your business, absolutely critical. You want somebody who is very polite but very persistent and isn't going to go away and is going to keep chasing and chasing and chasing until that money comes into your business, because it is legitimately yours. And you should be benefiting from it rather than somebody choosing not to pay that money when they should do. Again, when a business is owed money from customers, these are referred to as receivables. And where that is the case, then clearly it's very important that you try and get that money in as soon as you can, particularly when it becomes overdue, because it's your payment. You should really be receiving that payment, but you haven't been able to put that into your cash flow inflows because somebody's chosen not to pay for it. Timing of cash flows and inflows, again, then let's look at some cash outflows, okay? If your outflows are too quick, that's going to cause cash flow problems. If your timing isn't quite right, again, that's clearly something that we might want to try and negotiate. A firm might try to slow down its cash outflows, okay? It might negotiate with suppliers and say, can I have some more time to pay? Can we finance this over a longer period, for instance, okay? It might involve negotiating longer payment terms with your suppliers. If you've got a decent relationship with them, then clearly that is going to be the way to actually improve your cash flow position. And when we're talking about a business who owes money to suppliers, they are referred to as payables. So effectively, we still need to pay our suppliers that money. So we've actually made use of our goods, their goods and services, but we haven't necessarily paid for them yet. And as it says there, so the payment hasn't been made, okay? Now, cash flow problems then, clearly, one of the things that we need to think about is businesses need to have sufficient cash to meet their day-to-day finances. If they don't, it means they're not going to be able to buy stock, they won't be able to pay wages, they won't be able to pay utility bills. And clearly, if we have insufficient cash funds, that means we're not going to be able to meet our short-term debts, and that clearly is a major problem, okay? Now, to some degree, we might actually try to look at using bank overdraft. So in some cases, we might use the bank's facility to try and cover any short-term debts. But clearly, if we get to a position where we've got a bank overdraft and we've got trade creditors, that's clearly going to cause us a problem, because if both of those come due at the same time and we haven't got enough money to be able to pay, there is a danger that if the bank decided to foreclose on that overdraft, and also the trade creditors tried to do the similar sort of thing, that's going to cause us a significant issue and might actually cause our business to fold in time, okay? Clearly, in some cases as well, if we've got limited cash, that might mean we miss opportunities. And in this instance, what we really need to be thinking about is our cash flow problem either short or long term? If it's short term, we can normally find a means of financing it. But if looking at your cash flow forecast, you can see that in the long term, you're going to have cash flow problems, there is an argument to say that maybe you're not in the right business, or maybe you should use your resources in another way in order to try to improve that overall position, okay? Now, clearly, in some cases, businesses can survive short-term cash flow problems. However, long-term cash flow problems are a sign that basically a business isn't going anywhere fast, and it's going to need to think very seriously about how it might move forward in the future. Otherwise, there's a danger that it might go bankrupt. Other causes of cash flow problems then, credit sales. If we got long payment terms, too long payment terms, that clearly can be an issue. If our credit control is not very good, then clearly that's something we've got to try and address. We might, in some cases, do what's known as overtrade. And in this instance, that's where we're adding overhead and day-to-day expenses in the hope that we're going to get further sales in the future. And so growing businesses sometimes suffer from overtrading, so they'll spend a whole range of cash in thinking, right, we're really going to go for it, we're going to expand, blah, blah, blah. But in some cases, if that cash flow, those cash inflows don't come in the way that you expect, then overtrading can be a significant problem for businesses. It's clearly going to increase your capital expenditure, and there are all sorts of issues with overtrading. The internal management within a business, the stock control and the relationship with suppliers, very important when we're talking about trying to manage cash flows. And if you've got lousy stock control or you've got a bad relationship with your suppliers, there's a danger that that's going to cause friction, and also to some degree it will cause some cash flow problems. If your stock control is not very good, you might end up with a load of wastage. And if your relationship with suppliers is starting to get a bit tarnished, then clearly they might not supply you with the goods and services that you want in the time frame that you require them, and that's clearly going to put a massive strain on the relationship. And it's very interesting that if you do get cash flow problems, how quickly all of your suppliers seem to hear about it. So the issue is really that if you've got cash flow problems, you need to resolve them as soon as you can. Be very honest with your suppliers, and hopefully address that issue before it becomes you get a bit of a reputation for not paying your bills. Again, inaccurate planning, inaccurate forecasting can cause major issues as far as this whole process is concerned, and obviously seasonality in terms of sales. Other areas, and we've covered these, and this is really a summary, unexpected events can also cause a problem in terms of cash flow. So improving cash flow then, how can we improve cash flow? Number one, we could look at increasing the volume of inflows of cash. Obviously, that's one of the ways in which we could do that is by getting more sales. We might be able to speed up the timing of inflow of cash, both in terms of inflows, so the capital invested, any loans that we might get, any cash sales that we might get, any debtor payments, all of those things we could look at speeding up, or look at ways in which we might be able to address some of the issues. More often than not, the thing that can make the biggest difference is an increase in cash sales. And there are a number of ways in which you can do that. You can clearly advertise more, you can offer different price structures, and all those things hopefully might bring in more cash sales. Okay. In terms of other things that we can do, we can reduce the volume of outflow of cash, clearly slow down the timing of our outflow of cash, and outflows including loan repayments, day-to-day running expenses, and interest payments. If we can negotiate some of those and give ourselves some more time to do that, then that in some cases can be a significant way of improving our cash flow position. So a few things for you to think about. Okay, obviously I've gone through that reasonably quickly, and we've covered a reasonable amount of ground there. But let's take a look and have a think about these two questions. Then look at the previous slides. How can a cash flow forecast help to identify credit requirements, and how can a cash flow forecast help to minimise risk? Now, we've sort of talked about that through the course of this, but as a means of sort of checking your understanding, take a look back at some of the slides and any notes that you've made, and also check out on page 114 through to 116 of your Theme 1 booklet, Business Survival and Cash Flow, and that should help you to understand what is a really important principle, which is cash flow and cash flow forecasts. Okay, so thank you for listening, ladies. So that is Theme 1 pretty much done. In the next one-to-one or online tutorial, which I think is going to be on Friday, if I remember rightly, or is it going to be Thursday? I think it's going to be Friday. We'll take a look at cash flow, and also the work that we looked at as far as break-even analysis was concerned, and have a chat about that and make sure that you've understood it all. So thanks for listening once more, and we'll catch up on Friday.